I need to warn you about something that most people on Wall Street will never tell you publicly. A 50% market crash is not some theoretical worst-case scenario that belongs in academic textbooks. It is a real possibility that every serious investor needs to prepare for. And I am not talking about some distant future event. I am talking about something that could happen in the next 12 to 24 months, given the risks I see building in the global financial system right now. I have been in banking for over 40 years. I have lived through the crash of 1987 when the market dropped 22% in a single day. I navigated the dot-com collapse when the Nasdaq fell nearly 80%. I steered one of the largest financial institutions in the world through the 2008 crisis when the entire banking system nearly collapsed, and I can tell you with absolute certainty that the conditions for another major crash are present today. But here is what separates successful investors from everyone else. They do not just worry about crashes, they prepare for them. They know exactly what they will buy when panic grips the market and prices fall to levels that seem impossible during normal times. They have their shopping list ready, they have cash set aside, and when the moment arrives, while everyone else is selling in terror, they are buying the assets that will make them wealthy over the next decade. Today, I am going to share the only 4 stocks I would buy if markets crashed 50% tomorrow. These are not speculative bets or momentum plays. These are fortress businesses with the financial strength to survive any crisis and the competitive positions to emerge stronger on the other side. If you understand why I chose these 4 and you have the courage to act when others are panicking, you will be positioned to build generational wealth from the next market collapse. Let me take you back to September 2008. I was sitting in my office watching the financial system come apart in real time. Lehman Brothers had just filed for bankruptcy. The largest bankruptcy in American history, AIG was on the verge of collapse. Money market funds were breaking the buck. Credit markets had completely frozen. Banks that had survived for over a century were failing or being forced into emergency mergers. I remember the phone calls from Washington. Treasury secretaries and Federal Reserve chairmen asking what we could do to help stabilize the system. I remember the meetings where we discussed which institutions might fail next. I remember looking at our own balance sheet and making sure we had the liquidity and capital to survive whatever came next. But I also remember something else. I remember looking at stock prices and realizing that some of the finest businesses in America were trading at valuations that made no sense. Companies with dominant market positions, strong cash flows, and minimal debt were being sold at prices that implied they would go bankrupt. The market was not distinguishing between companies that deserved to fail and companies that would not only survive but thrive. That crisis taught me something invaluable about what to look for in crash investments. You want businesses with 4 specific characteristics. First, they must have balance sheets strong enough to survive extended economic stress without needing to raise capital at distressed prices. Second, they must have competitive positions so dominant that temporary economic weakness does not permanently impair their franchises. Third, they must generate cash even during recessions, providing both survival capability and fuel for opportunistic investments. Fourth, they must have management teams that have navigated crises before and know how to play offense when competitors are playing defense. The 4 stocks I am about to share all possess these characteristics. They are the businesses I would put my own money into if markets fell 50%. And I want to explain not just what they are, but why they meet my criteria, so you can evaluate opportunities using the same framework. The first stock I would buy in a 50% crash is Berkshire Hathaway. Now, I know some people might find it strange that a banker would recommend a company run by someone who has been publicly critical of banks at various points. But when it comes to surviving and profiting from market crashes, nobody has a better track record than the team at Berkshire. Let me explain what makes Berkshire uniquely positioned for crisis investing. They currently hold over $300 billion in cash and short-term investments. $300 billion, that is not a typo. While most companies struggle to maintain a few months of operating expenses in reserve, Berkshire has built a war chest that could buy most companies outright without borrowing a single dollar. This cash position is not an accident. It reflects a deliberate strategy of maintaining overwhelming financial strength, precisely so they can act decisively when opportunities arise. During the 2008 crisis, when credit markets were frozen and most companies could not access capital at any price, Berkshire was writing checks. They invested $5 billion in Goldman Sachs, $3 billion in General Electric. They made deals that generated billions in profits because they were the only ones with both the capital and the courage to act. The operating businesses within Berkshire are equally impressive from a crisis survival standpoint. The insurance operations generate float, essentially free capital that can be invested while waiting to pay claims. The railroad and utility businesses provide essential services that generate revenue regardless of economic conditions. The manufacturing and retail businesses span dozens of industries with different economic sensitivities. This diversification means that even a severe recession does not threaten the overall enterprise. When you buy Berkshire during a crash, you are buying a company that will use the crisis to get stronger. While competitors fail or retrench, Berkshire will be acquiring distressed assets at bargain prices. They will be extending capital to desperate companies at terms heavily favorable to Berkshire. They will be hiring talent that is suddenly available as other firms contract. Every crisis in Berkshire's history has left them relatively stronger than before. The management succession question has been largely resolved. The operating structure allows the business to function effectively regardless of who sits in the top chair. The culture of decentralized decision-making with centralized capital allocation is embedded deeply enough to persist through leadership transitions. I have confidence that Berkshire will be managed intelligently for decades to come. At current prices, Berkshire trades at modest premiums to book value. In a 50% crash, it might trade at or below book value. That would represent an extraordinary opportunity to buy one of the most durable business franchises ever assembled at a price that implies no premium for the quality, the cash position, or the future acquisition opportunities that a crash would create. I want to share something about the psychology of crash investing that Berkshire exemplifies. During panics, investors make decisions based on fear rather than analysis. They sell quality companies alongside garbage. They assume that falling prices reflect deteriorating fundamentals, when often they reflect nothing more than forced selling and emotional capitulation. Berkshire has been on the buying side of these dynamics throughout its history. When investors were dumping Bank of America shares during the European debt crisis, Berkshire was buying. When investors were fleeing airline stocks during the pandemic, Berkshire owned significant positions. Not every decision works out perfectly, but the pattern is consistent. They buy when others are fearful. The insurance float deserves additional explanation because it is central to Berkshire's competitive advantage. Insurance companies collect premiums up front and pay claims later, sometimes years or decades later. The money sitting between premium collection and claim payment can be invested. For most insurers, this float comes at a cost because claims and expenses exceed premiums. But Berkshire has historically generated underwriting profits, meaning they are actually paid to hold other people's money. This free leverage, earning investment returns on capital that cost nothing to obtain, has been the engine of Berkshire's compounding for decades. During crashes, this advantage amplifies. They can deploy float into discounted securities while competitors are dealing with their own problems. The combination of massive cash reserves plus massive free float creates unmatched capability to capitalize on distress. The second stock I would buy in a 50% crash is Johnson & Johnson. This company represents everything I look for in crisis investments: dominant market positions in essential products, fortress balance sheet, consistent cash generation, management that has navigated every economic environment for over a century. People sometimes dismiss consumer staples companies as boring. They want exciting technology stocks or high-growth disruptors, but during crashes, boring becomes beautiful. When the economy contracts, people still get sick. They still need bandages and pain relievers and prescription medications. They still brush their teeth and wash their hair. Demand for essential consumer products is remarkably stable regardless of what stock markets or GDP numbers are doing. Johnson & Johnson owns leading brands across consumer health, pharmaceuticals, and medical devices. Their consumer business includes names that have been in households for generations. Their pharmaceutical business produces medicines that doctors prescribe regardless of economic conditions. Their medical device business supplies products that hospitals need for surgeries that cannot be postponed. The financial strength is exceptional. Johnson & Johnson is one of only 2 companies in the world with a AAA credit rating. That means the bond market views their debt as essentially risk-free. They could borrow at rates barely above government bonds, and they have maintained that rating through every crisis, every recession, every market panic for decades. The dividend history speaks to their durability. Johnson & Johnson has increased their dividend for over 60 consecutive years. Think about what that means through the stagflation of the 1970s, through the crash of '87, through the dot-com bust, through the 2008 financial crisis, through the pandemic. Every single year, they raise the dividend. That consistency reflects underlying business strength that transcends any individual economic cycle. In a 50% crash, Johnson & Johnson stock might fall to levels where the dividend yield approaches 5 or 6%. You would be locking in a growing income stream from one of the safest businesses on the planet at yields typically reserved for much riskier investments. That is the kind of opportunity that can set you up for decades of growing income, regardless of what markets do. Let me elaborate on why the pharmaceutical and medical device businesses provide such strong recession resistance. When you need a medication that manages a chronic condition, you do not stop taking it because the economy is weak. When you need surgery, you do not postpone it indefinitely because stock markets are falling. Healthcare spending is one of the most stable categories in the entire economy. The research pipeline provides growth optionality that is not fully reflected in recession scenario analysis. Johnson & Johnson invests billions annually in developing new drugs and medical devices. Some of these investments will produce blockbuster products that generate tens of billions in revenue over their patent lives. This innovation engine continues operating regardless of economic cycles, creating value that will be recognized when conditions normalize. The global footprint provides geographic diversification that matters during regional crises. If the American economy weakens severely, European and Asian operations provide offsetting stability. If one region faces particular challenges, others likely continue performing normally. This diversification reduces the volatility of overall business performance, even when individual markets struggle. I also appreciate the legal structure they have implemented to manage litigation risk. By separating certain liabilities into distinct legal entities, they have protected the core operating businesses from existential legal threats. This structure has drawn criticism, but from an investment perspective, it reduces tail risk substantially. The company you are buying is more insulated from worst-case legal outcomes than it was historically. The third stock I would buy in a 50% crash is JP Morgan Chase. Now, I understand the irony of recommending the company where I have spent my career, but I am not recommending it because of any personal connection. I am recommending it because I know better than almost anyone how strong this institution actually is and how well positioned it would be to profit from financial system stress. Most people misunderstand what happened in 2008. They think all banks were equally reckless, equally vulnerable, equally deserving of failure. That is simply not true. Some banks had gorged on subprime mortgages and complex derivatives without understanding the risks. Others had maintained discipline, kept strong capital ratios, and avoided the worst excesses. When the crisis hit, the difference became obvious. JP Morgan was able to acquire Bear Stearns and Washington Mutual at distressed prices because we had the capital strength and operational capability to absorb them. We emerged from the crisis with dramatically increased market share in investment banking, trading, and consumer banking. The crisis was devastating for the industry, but it was actually strengthening for JP Morgan relative to competitors. That same dynamic would play out again in another crash. Weaker banks would struggle with loan losses and capital shortfalls. They would retrench from businesses, cut lending, lose talent. JP Morgan would maintain offensive capability. We would continue supporting clients. We would hire the best people fleeing struggling competitors. We would gain market share in every business line. The regulatory environment since 2008 has actually enhanced the competitive position of the largest banks. Higher capital requirements create barriers to entry. Compliance costs favor scale. The too big to fail, implicit guarantee, while controversial, provides funding advantages that smaller competitors cannot match. The banking industry has consolidated dramatically, and further consolidation is constrained by regulation. The major banks operate in what is effectively a protected oligopoly. The current valuation reflects excessive pessimism about banking profitability, credit losses, and regulatory risks. In a 50% crash, shares might trade at substantial discounts to tangible book value. You would be buying one of the most dominant financial franchises in the world at prices implying the business is worth less than its hard assets. History shows that buying great banks at discounts to book value during panics generates exceptional returns over the following years. I should address the risks honestly. Banks are inherently leveraged institutions. Their assets exceed their equity by multiples. A severe enough crisis with large enough loan losses could impair any bank. But JP Morgan has stress tested against scenarios far worse than the 2008 crisis. The capital buffers are designed to absorb losses that would exceed anything we experienced then. The liquidity position allows us to meet obligations even if funding markets completely freeze. I am confident in the institution's ability to survive anything short of complete societal collapse. The diversification of revenue streams provides stability that pure-play financial companies lack. We have consumer banking operations serving millions of households. We have corporate and investment banking serving the largest companies and governments in the world. We have asset and wealth management serving institutional and individual investors. We have payments and processing businesses embedded in global commerce. No single business line dominates and no single client concentration creates existential risk. The technology investments we have made position us for the future of financial services. We spend over $15 billion annually on technology. That is more than most fintech companies are worth entirely. This investment builds competitive advantages in digital banking, in fraud prevention, in data analytics, in customer experience. The gap between our technological capabilities and those of smaller competitors continues to widen. Let me share something about how banking works during crises that most investors do not fully appreciate. When credit tightens, when other lenders retreat, the banks that maintain lending capacity gain market share rapidly. Relationships that took competitors decades to build can be captured in months when those competitors are unable to serve their clients. Every banking crisis in history has resulted in market share consolidation toward the strongest institutions. We have been on the winning side of that consolidation repeatedly. The dividend provides meaningful yield that supports the stock during downturns. Even in severe stress scenarios, we would prioritize maintaining the dividend. The payment represents a small fraction of our earnings capacity and an even smaller fraction of our capital. Investors can count on that income stream continuing through economic cycles, providing return even when price appreciation is unavailable. The fourth stock I would buy in a 50% crash is Costco. This might seem like an unusual choice compared to the others, a warehouse retailer alongside a conglomerate, a healthcare giant, and a money center bank. But Costco possesses characteristics that make it uniquely valuable during and after market crashes. Let me explain the Costco business model, because most people do not fully appreciate how powerful it is. Costco operates on razor-thin gross margins, much lower than traditional retailers. They make almost no money on the products they sell. Instead, they charge membership fees that provide nearly all of their profits. This creates a fascinating dynamic. The membership model means Costco is not really competing on the same basis as other retailers. When customers pay their annual fee, they are psychologically committed to shopping at Costco to get value from that fee. Membership renewal rates exceed 90%. This is subscription business economics applied to retail, creating predictable recurring revenue that persists through economic cycles. During recessions, Costco actually benefits from trading down. Consumers who previously shopped at premium grocers switch to Costco to save money. Businesses that purchase supplies from expensive vendors switch to Costco for better pricing. The value proposition becomes more compelling precisely when consumers are most price sensitive. The financial strength is underappreciated. Costco generates billions in free cash flow annually. They have minimal debt relative to their cash generation. They return capital to shareholders through dividends and occasional special dividends. They have the resources to invest through downturns while competitors retrench. The real estate position is also valuable. Costco owns many of their warehouse locations in a severe crash with commercial real estate stress. They would not face the risk of landlords failing or lease terms becoming problematic. Owned real estate provides stability that leased locations cannot match. The competitive moat continues to widen. The buying power that comes from Costco's scale allows them to negotiate prices that smaller competitors cannot match. Their private label brand has earned consumer trust that translates into higher margins on those products. The treasure hunt shopping experience with constantly rotating merchandise creates engagement that online competitors struggle to replicate. In a 50% crash, Costco might trade at valuations not seen in decades. You would be buying a business that actually performs better during economic stress at prices reflecting market-wide panic, rather than company-specific problems. That combination of defensive business characteristics and discounted valuation creates compelling opportunity. There is something almost counterintuitive about Costco as a crash investment. Retail is generally considered cyclical and vulnerable to economic downturns, but Costco operates on a model so different from traditional retail that the normal rules do not apply. They are selling necessities at the lowest possible prices to a customer base that becomes more committed during tough times, not less. The employee relations deserve mention because they contribute to competitive advantage. Costco pays wages significantly above retail industry averages, then provide benefits that competitors do not match. This attracts and retains better employees who provide better customer service and operate more efficiently. The low turnover reduces training costs and maintains institutional knowledge. What appears to be higher labor expense actually produces better economics when you account for productivity and retention benefits. The warehouse expansion provides long-term growth visibility. Costco opens roughly 20 to 30 new locations annually in carefully selected markets. Each new warehouse represents incremental revenue and profit. The real estate strategy of buying rather than leasing locations means they capture the benefit of appreciating property values over time. The physical footprint creates presence that online competitors cannot replicate. International expansion offers decades of additional growth opportunity. Costco operates in relatively few countries compared to the global addressable market. Each new country entry represents significant incremental opportunity. The model has proven transferable across cultures with operations in Asia, Europe, and Australia all performing well. The international expansion runway extends far into the future. I want to highlight something about Costco's behavior during previous downturns. While other retailers were closing stores, cutting staff, and retreating, Costco continued expanding. They continued opening new warehouses. They continued investing in the business. They emerged from each downturn with enhanced market position. That pattern would repeat in the next crash. While competitors struggle, Costco will continue executing its long-term strategy. Now, let me explain the common principles that unite these four stocks, and that should guide your thinking about crash investing more broadly. First, all four companies have fortress balance sheets. They have the cash, the credit lines, the financial flexibility to survive extended periods of economic stress without making desperate decisions. Companies that enter crises with weak balance sheets often have to raise equity at the worst possible prices, diluting existing shareholders, or they have to sell assets under pressure at distressed values, or they have to cut investments that would position them for recovery. Strong balance sheets avoid all of these value-destroying outcomes. Second, all four companies have competitive positions that crises cannot impair. Then market shares, their brand values, their customer relationships. These assets do not disappear during recessions. If anything, crises strengthen dominant companies relative to weaker competitors who cannot maintain service levels or investment during stress. You want to own the companies that emerge from crashes with enhanced competitive positions. Third, all four companies generate cash through the cycle. This is crucial because cash generation during downturns provides both survival insurance and opportunistic firepower. Companies that burn cash during recessions must cut costs, reduce investment, and often raise dilutive capital. Companies that generate cash can maintain or increase investment, acquire distressed competitors, and return capital to shareholders at depressed prices. Fourth, all four companies have management teams experienced in navigating crises. This matters more than people appreciate. Crisis management requires different skills than normal operations. It requires the judgment to distinguish between temporary problems and permanent impairments. It requires the courage to make contrarian decisions when consensus is pointing the other direction. It requires the relationships with counterparties, regulators, and capital sources that can only be built over years. Inexperienced management teams make mistakes during crises that experienced teams avoid. Let me address how to actually implement this strategy, because having a shopping list is necessary but not sufficient. You need to have cash available when crashes happen. This seems obvious, but most investors are fully invested at market peaks. They have no dry powder when opportunities arise. I recommend maintaining a meaningful cash reserve specifically designated for crash buying. This cash will feel like a drag on returns during bull markets, but it provides crucial optionality when markets fall. You need to size positions appropriately. Even the best companies can fall further than you expect during panics. If you invest everything at the first sign of a crash, you may find yourself fully invested before the bottom is reached. I recommend scaling into positions over time during crashes rather than trying to call the exact bottom. You need to have the emotional discipline to act when every instinct is screaming to sell. This is the hardest part. During crashes, the news is uniformly terrible. Experts are predicting disaster. Your portfolio is bleeding red. Every day brings new reasons to believe things will get worse. The investors who profit from crashes are those who can execute their predetermined plan despite the emotional pressure to abandon it. You need to ignore the macro predictions and focus on company fundamentals. During crashes, everyone becomes a macroeconomist. They debate whether the recession will last 6 months or 2 years. They argue about policy responses and their effectiveness, but the specific economic outcome matters less than you think for high-quality companies. Whether GDP falls 2% or 5%, Berkshire will still be well positioned. Johnson & Johnson will still sell bandages. JP Morgan will still process payments. Costco will still sell groceries. Focus on what you can analyze rather than what you cannot predict. I want to share something about the relationship between price and risk that most investors get backwards. They think that lower prices mean higher risk because something must be wrong if the price has fallen so much. But for quality companies, lower prices actually mean lower risk. When you pay less for the same future cash flows, your margin of safety is larger. The potential downside is reduced. The probability of earning acceptable returns is increased. Price declines in quality companies create opportunity, not danger. The behavioral challenge is real and should not be underestimated. I have watched highly intelligent people make terrible decisions during panics, people who understood the companies they owned, who had analyzed the balance sheets, who knew the businesses would survive. They sold anyway because the emotional pressure became unbearable. Developing the emotional discipline to act rationally during panics requires practice and preparation. If you have not thought through how you will react, you will likely react poorly. One technique I find helpful is writing down your investment thesis before a crash happens. Document why you would buy each company at various price levels. Review this document periodically. When a crash arrives, you have pre-committed to a course of action. You are executing a plan rather than making decisions under extreme emotional stress. This pre-commitment reduces the likelihood that fear will override reason. Let me also share what I would avoid during crashes, because knowing what not to buy is as important as knowing what to buy. Avoid companies with weak balance sheets regardless of how cheap they appear. During crashes, cheap often becomes cheaper and then worthless. Companies that need to refinance debt during credit crunches may not survive. Companies that need to raise equity will dilute shareholders dramatically. The apparent bargains among financially weak companies are often value traps that destroy capital. Avoid companies with cyclical businesses tied to discretionary spending. Luxury goods, travel, entertainment, these businesses suffer disproportionately during recessions. Their revenues can fall 50% or more, even if they survive. The recovery path is long and uncertain. You want companies with stable demand, not companies riding economic cycles. Avoid companies where you do not understand the business model. Crashes are not the time for learning experiences. You need conviction to buy during panics. That conviction can only come from deep understanding of how a business makes money, what threatens it, and why it will survive. If you cannot explain the investment thesis simply and completely, do not buy it during a crash. Avoid the temptation to bottom fish in the most beaten down sectors. The sectors that fall most during crashes often deserve to fall. They have structural problems that the crash is exposing. Trying to catch falling knives in fundamentally challenged industries is a recipe for permanent capital loss. Stick with quality even if it seems boring compared to the dramatic declines elsewhere. Let me close with some perspective on why being prepared for crashes matters so much for long-term wealth building. The mathematics of recovery from losses are brutal. If your portfolio falls 50%, you need a 100% gain just to get back to where you started. Most investors experience crashes as permanent setbacks because they sell near the bottom, lock in losses, and never recover. But investors who buy quality during crashes experience them as the most powerful wealth-building opportunities of their lives. I have watched this pattern repeat across my entire career. The investors who built the largest fortunes were not the ones who avoided crashes entirely. That is impossible. They were the ones who used crashes as buying opportunities. They added to positions when prices fell. They maintained conviction when sentiment was darkest. They emerged from each crash with larger ownership stakes in quality businesses purchased at discounted prices. The four stocks I have shared today, Berkshire Hathaway, Johnson & Johnson, JP Morgan Chase, and Costco, represent the type of businesses that reward crash buying most consistently. They have the financial strength to survive. They have the competitive positions to emerge stronger. They have the management quality to navigate stress intelligently, and they trade at valuations during crashes that create opportunity for exceptional long-term returns. The next crash is coming. I do not know if it will happen next month or next year. I do not know if the trigger will be geopolitical conflict, financial system stress, or something entirely unexpected. But I know with certainty that markets will fall dramatically at some point. The question is whether you will be prepared to act when that moment arrives. Build your shopping list now. Accumulate cash reserves. Now develop the emotional discipline. Now when the crash comes, and it will come, you will have the opportunity to make investment decisions that shape your financial future for decades. Do not waste that opportunity by being unprepared or by letting fear override. Even the greatest investors in history have all shared one characteristic. Then buyers during panics while everyone else was selling. If you can develop that capability, if you can maintain conviction when the world seems to be falling apart, you will join their ranks. The four stocks I have shared today are where I would put my money. Now you have to decide where you will put yours. I have seen too many people reach retirement with less than they should have because they made poor decisions during crashes. They sold at the bottom. They waited too long to get back in. They let one or two bad experiences and panics permanently impair their wealth-building trajectory. Do not let that be your story. The four companies I have described today, Berkshire Hathaway, Johnson & Johnson, JP Morgan Chase, and Costco, represent exactly what you should own during market panics. Fortress balance sheets, dominant competitive positions, consistent cash generation, experienced management. These characteristics do not guarantee success, but they dramatically improve your odds of surviving crashes and profiting from them. Start preparing now, build your cash reserve, finalize your shopping list, develop your emotional discipline. The crash will come eventually. It always does. The only question is whether you will be ready to act when it arrives. Make sure the answer is yes.